Hello, all. It is Rob Kosky again, here with my partners, Matthew Ringel and Jason Phipps. Well, it's that time again. The market gets volatile. DLAK sends out a video. Well, the market has decided that volatility is the story of the day. And we realize the importance of keeping you, our clients, who entrust us with their hard-earned money, up to speed on our thoughts and potential actions. Let's be clear. The volatility is 100% because of uncertainty, threats of, and actual tariffs. At the same time, we, and I most, always need to be clear-headed, never political in my thinking. You deserve and I need to be mindful to what I believe is the outcome will be, but I need to never be rooting in one direction or the other, as that would cloud the statistical probabilities of what the outcome may actually be. So I will sit here today and share that, yes, tariffs are inflationary. Inflation has been, over the past 5 years, the biggest threat and concern to our economy and the markets. I have two very specific takes on tariffs. One, I do believe, and is clearly not going out on a limb, to state that Trump and his administration are committed to tariffs. Y'all shocked? Probably not. That being said, I have to believe they understand that intermediate-term inflation is never transitory. And once it is embedded in the economy and has flowed its way to wage inflation, inflation is very sticky. If they do understand this, they will continue to be all over the map as to the implementation of these tariffs. And I don't think that shocks anybody also that Trump's all over the map. Okay. Can this economy withstand short-term shocks? My take is unequivocally. If I have to predict an outcome that I can play, a combination of tariffs and serious 1 to 1.5% short-term uptick in unemployment would lead to a slower economy and a mid-level pullback in the markets. All right. Second take on tariffs. Crony capitalism stinks. But the upside is that it could be played as a market participant. You can love Trump, but you cannot deny, as you also can't deny the last administration was doing its best to pick winners and losers within the economy. Yep. Hate it. But it does sort of like I can share when they had the infrastructure bill in the last administration, we put on a very specific position that totally took advantage of that. And it was like taking candy from a baby. Not unlike 2022, where it was so obvious that everything the government was doing was inflationary. Okay. Funny thing is, so far, the exact opposite as to what one would expect has actually occurred within the market as it pertains to what we're seeing. The developed international markets this year are up around 11.5% as of March 5th. The S&P is basically break even. Small caps are down, and the dollar is crashing. What would we have expected? We would have expected the announcement and implementation of tariffs is that the bond market would have started crashing. Interest rates would have started going up. The dollar would have started going up. Tariffs is the definition of protectionism. In that particular manner, as large as our economy is, multinationals would suffer. Small caps, which sell almost all of their products domestically, would do well. Well, none of that has happened. In essence, the exact opposite has happened, is the dollar is actually starting to crash. But from where we're starting, don't forget, we came into 2025 with large U.S. stocks at their second most expensive level that we've ever experienced. And the dislocation between U.S. stocks and international stocks on a valuation measure was just, magnificent. So conclusion, though, is the only way this rotation has long-term legs is if you're in Japan, learn that you have to sell more product and secure more gains for investors. If you don't do that, you deal with what they have dealt with for the past 15 years. I know we recently had a podcast, Matt, where we talked about the size of our economy and Europe's economy was not significantly different, 15 years ago. And now, I mean, you can drive a super Walmart between the two economies now because Americans embrace growth and risk-taking and et cetera.
All right. Well, Rob, the important question that I want to kind of interrupt here with this has been a great analysis, but are we going to have a recession or not?
Great question, Matthew. My crystal ball says, I don't know. Okay. So let's talk. But once again, as you know, I probably don't have a simple answer for it. I'll take you back to 2021. 2021, I was sitting in an investment conference and speaking at the conference in a small room. So it was an opportunity to have a give and take, was a PhD economist from the government. And we had a healthy, friendly debate. So I had shared my thoughts in the fall of 2021, which was before 2022 when inflation became unmanageable and killed stocks and bonds, is that I believed we needed a healthy reset by experiencing, hopefully, a shallow recession. I wanted to see the government not get involved, allow the recession that everybody was predicting to take place. And after this overemployment of what we had after the pandemic, that we could loosen up the job market in a manner where we went from 4% unemployment to maybe 6, if not 7% unemployment. And we did not experience that. Okay. Fast forward to today. Well, actually, if I take a step back on that, what would have occurred had what I said taken place? What did occur? The stock market dropped 20% in 2022. It would have anyway. The bond market dropped 13% in 2022. It would not have occurred. We would not have what I just expressed is this embedded inflation. We would have not had it go through to the wage market in a manner where we were hearing where there were unions last year getting 50% raises over a 3-year time period. Okay. Now fast forward to today. Do we need a recession? I'm not going to say we need one. I absolutely believe we will experience a slowdown. And that's not bad. As noted above, tariffs are inflationary. Slowdowns are the exact opposite. They're anti-inflationary. I haven't yet talked at all about government employment, which I'm sure everybody's hearing everything about. But I'm going to throw some knowledge at you and facts. In 2023, our economy was extremely healthy from a job standpoint in that our economy created multi-millions of jobs. Get ready to fall out of your seat. 25% of all the jobs created in 2023 were government jobs. Okay? In 2022 and 2023, our economy generated 1 million new government jobs. Okay? With everything that's going on now, could we see 1 million government employees laid off in the next year? Possibly. Could there be a spillover? Absolutely. Both, once again, though, are anti-inflationary. So I'm not going to come to a conclusion and put myself on the line and say we're going to have a recession or not, because I think some of the ways they measure recession may not be perfect as it is. But I don't know if it could be put any better, or I appreciated what I heard any more, that on CNBC this morning, the Treasury Secretary, Scott Bessent, could not have better made the statement clearer in saying verbatim, there's an adjustment to go through as we detox from too much government spending. Okay? It's natural. That could lead to a slowdown. You throw in some of the significant uncertainty to the government. So, Jason, pullbacks, normal, not normal? What's your take in terms of what we're going through and has it compares to historians?
Great question, Rob. In fact, pullbacks are very normal. What you will hear the talking heads on CNBC refer to as a correction is defined by a pullback in the stock market of more than 10%, but less than 20%. And since 1980, we've had a correction on average once every 14 months. And it's been since 2022, since we've had our last correction.
We did a lot of buying right about that time.
Yes, we did. Yes, we did. Busy time.
Yeah. And it wasn't really that we knew it was the bottom. It's just we do so many things here based upon statistically. Statistically, the market had dropped 30%. So statistically, was it going to continue to go down? So they don't have a crystal ball. That's how we make decisions. But
yep. Matt, why don't you share with everyone what our thoughts and actions are going to be around what's going on today?
Yeah, good point, Jason. I think that's what a lot of the listeners here are wanting to really hear about is what are we doing?
We made them, I talked way too much.
That's right. What are we doing about this situation, right? And well, you sit there and say, are we panicked? Are we going to spend time this weekend losing sleep? I think I can confidently say for everyone up here, no, we're not. And the reason is because, as Jason said, volatility is normal in the market, right? And we strongly believe that this AI technology that's come out is going to massively impact and help these growth concerns, at least more in the intermediary term.
Yeah, not immediately. It's not like it's going to save us tomorrow.
Yeah. Well, it's going to take time to implement.
Yeah.
Right?
And so, we had a pullback, and certainly that's going to be something where productivity gains over the long term are going to be so significantly impacted that, let's talk about an email that I sent yesterday. You remember getting it?
Yeah, I did. I actually got an email for Rob, and he doesn't want me to tell you this, but well, he's here. So, but he got this email, and it said what? The Dow was down 10%, and the S&P was down.
NASDAQ was down 10, and
NASDAQ was down.
The S&P was down like 6. I think I said.
Yeah, and I think the headline was halfway there, right? So that's kind of our expectation, right? Is we don't see possibly a recession, maybe, but we won't go there, but. Certainly wouldn't be shocked if there's maybe a 15% pullback. And really, to be honest with you, it's a good thing. It's a good thing in the sense that it provides us a buying opportunity. So maybe you're one of the clients, maybe you're not, but we've had lots of clients over the last 6 months hand us cash out of their bank and say, what are you going to do with it? Right? Rob, I'm sure, has told people this. Jason has as well. The answer has been, hey, we're going to stick it in a money market. We're going to earn some interest, and we're going to wait for there to be buying opportunities in this market. Well, if we do get this 15% pullback, you can bet a lot of that capital is going to go to work. And that's really the point. We have to have these pullbacks to be able to buy in, to have a longer term upside in this market.
Yeah. So the conclusion for me would be statistically, from a standpoint of the tax cuts, the cuts in regulation, and a productivity gains with AI, I would love to be able to get more money put to work at potentially a little bit lower prices than we have today. So you all have a great one. It is always our pleasure to serve you and service you.
Take care.